Okay. All right. I'm good too. Okay, so this meeting has been recorded. So can we do a quick revision of what we did the other time?
Right.
This is to check if we are pricing and all that. Is that truth?
But sir, I thought we are supposed to be having class in every 2 weekends. So.
Every 2 weeks? No, please. It's not every 2 weeks.
So it's every.
We have a lecture for
every weekend.
We have a lecture for every weekend. I think it's 4 weeks or so, and we have presentations for 2 weeks. And you prepare for your quizzes and exams.
Okay, sir.
All right. So, anyone to give us a brief or an overview of what we did in our first meeting last week? I mean, this Saturday. Anyone to help us? You remember anything we did last week? All right. Okay.
Yes,
so,
sir.
Let's move on to today's activity. Okay, Trish.
Yes, sir. We learned about meaning of accounting. Then we also learned about the meaning of bookkeeping. Then elements of financial statement or yes, sir.
Statement.
So we learned about assets, liabilities, equities, income, and expenses.
Oh, okay.
Yes.
All right, that's good. Thanks for the update.
Yeah.
So today we are going to look at the chapter 2, that is the unit 2. And we are going to look at the conceptual framework of accounting. The conceptual framework of accounting. All right, so this is the main objective for today. This is what we aim to achieve at the end of this meeting. You should be able to mention and explain the main element of a balance sheet. Even though I know we went through this in our previous meeting, cut across this unit 2. And also mention and explain the main elements of a profit and loss account. If you remember last week, we talked about the income or the revenue, the expenses, we talked about the expenses, the gain.
Madam Erica, are you there?
Yes, please.
Oh, okay. I say I'm the only one in the class, that's why I'm asking.
Oh no, I'm here.
So,
it seems the network is not stable.
right.
Yeah.
Yes. But can you see my screen now?
No, sir.
No, sir.
No, sir. It's not sure.
What's happening? Can't figure out what's wrong. I think we are on now.
Yeah.
Please, can you see now?
Yes, sir.
Yes,
All right.
please.
So can you prompt me when it dropped? I think the internet is not really strong today.
Okay.
So we discussed the two main approaches to income measurement. Okay, you have the two main approach to when it comes to measuring income. You can use the asset approach, asset and liabilities approach, or income and expenses approach. These are the main approaches to income measurement. Or we also list and explain the basic assumptions in accounting. As an accounting student, there are some basic assumptions, in accounting you are supposed to know. And five, we mention and explain the main conventions or principles that is being used in accounting. Once you mention this principle as an accounting student or as an accountant, you should be able to explain what it means. Or it's a must to know, it gives the vibe that, yeah, you are learning something, or indeed you understand the field in which you are operating. All right. Six, we discuss the importance and also the shortcomings of the main accounting principles. Okay. All right. So, as I mentioned earlier, we have two main approaches to income measurement. That is the assets and liabilities approach, and also the income and also the expenses approach. When we talk about the assets and liabilities approach, we are simply looking at the equity or net equity approach. Is that true? You remember equity, right? Assets less liability. Do you still remember? Are you there?
Yes.
Yes, sir. Yes, I remember, sir.
Yeah, good. So that is what we meant by the asset and liabilities approach. So simply, when you have your total assets and your total liabilities, you less your liabilities from your assets and you get your capital or equity, which in another way is termed as your income. Okay. All right. So total asset less total liability is the interest of the honest. So your total assets and your total liabilities. When you less the total liabilities from your total assets, you get your equity interest or your interest in the business. The residual value is called capital or owner's equity. So that's how we term it, capital. So they are in the accounting equation, we have assets, capital, assets, liabilities, and capital. So assets minus liabilities equals what? Capital. Okay. If a business entity earns a profit, the profit goes to increase the owner's equity. Anytime business makes profit, it increases your equity, it increases your stake or your interest in the business. Anytime profit is being made, your interest that you have in the business increases. You know, right? Anytime you are doing a business and you make a profit, automatically it increases your capital, especially if you are not plowing back or if you are not taking out the profits from the business. So anytime you make a profit, your capital is increasing because that money has been invested in the business and it's just yielding and yielding upon. Okay. Example, if books which cost 100,000 Ghana cedi are sold for 140,000, the assets will increase by 40,000. Do you agree to that?
Sir, come again.
I'm reading the example from here. That if books which cost 100,000 are sold for 140,000, the assets will increase by 40,000. You agree to that?
Yes, please.
Yeah,
Yes.
good. Because there has been an additional profit of 40,000 on the book, the cost of the book. So you are going to make a profit of 40,000 and it's going to increase your assets. All right. So as we just discussed, if you are not plowing back, if you are plowing back your profit into the business, it means that your capital is going to increase. Let's assume your capital is 100,000. It means it's going to increase by 40,000. Right. So the net income here is the difference between the cost of the item you sold and the selling price. That is what gives you the net income. So the difference between the ending owner's equity and also the beginning owner's equity. It's a given period, which is also subject to adjustment for additional capital and drawings within the period. So this is what we are talking about. You started a business with a capital of maybe 100,000, okay? At the end of the year or at the end of your business cycle, every person have a business cycle aside the normal accounting year, which is January to December. Maybe your business, you employ somebody there, okay? So every 3 months you go there to do stock taking, or you go there to collect the sales for the 3 months. Then you check, you compare the stock after January, and you check the total stock available after the time you went to do the account. Okay, so if you are all following the normal business cycle, which is one financial year, January to December, it means that in January, whatever investment or whatever resources you started with begin. So that becomes the opening capital. The opening capital. Then, as at the end of the year, you also check your capital at the end of the year. That is your closing capital. Then you compare these two, the opening capital and also the closing capital, to check if there has been an increase in the owner's equity or a decrease in the owner's equity. And when there is a decrease, I'm sure you know what it could possibly mean, right? What could that possibly be?
Yes, sir.
What will
It
it be?
means there is a loss.
Good. Either there is a loss or maybe there was too much drawings. Because if you paid attention to the statement I read, there are other things that may affect the difference between these two. There can be some additional capital. Maybe along the way you introduce additional capital. So it means that your closing capital will be more than your opening capital. Or there can be profits. Profit is going to increase your capital, as we just gave in the example. Or maybe drawings. Maybe along the line, something happened. Somebody needed some money, so you have to sort some people out. You took money from the business. That becomes drawings. It's not an expense. It's when you take money out of the business, it becomes drawings. Especially if you're not using it for something for the business purposes, it becomes drawings. So maybe you withdrew money from the business, and because of the drawings, now you withdrew more than even the profit you made. So it has eaten into your capital, which means that at the end of the period, your opening capital is even going to be more than your closing capital, which is not supposed to be so. All right. And now you know how to ascertain your capital. If you are using the asset and liabilities approach, you know how to get your capital is the same as your net interest, is the same as what the equity, as highlighted in the slide. Let me highlight it. Okay. We call it the net interest. Also, owner's capital can also term it as owner's capital or the net interest. All right. So this is what I'm talking about. So the difference between the ending owner's equity and also the beginning owner's equity of a given period, subject to adjustment. And now we've spoken about adjustment. Some of them can be drawings. Maybe additional capital was introduced. Or maybe, you didn't make a profit, you made a loss. So it means it's going to eat into your capital. You are not even going to get the money invested. How much more having an additional money to it? That's what we are talking about. All right, so let's give an illustration here. Who can read it for us? Can somebody read it for us so that we all go through? Who will do the reading for us? I want to involve all of
Yes,
us, so
please,
maybe
Ari.
somebody. Okay, Patrick.
At the beginning of 2019, the assets and liabilities of ABI Enterprise, a trading concern, were premises 26 Ghana cedi, vehicle 15 meters Ghana cedi, stock 6.6 meters Ghana cedi, trade debtors 17.8 meters. Trade creditors
Okay,
12.
Patricia,
It's million.
Sorry.
Patrick, can you hear me?
Yes,
Yeah, the
please.
M is me for millions. It's
Million.
millions.
Oh, okay. Then I'm taking it
Yeah,
again.
all right,
At the
okay.
beginning of 2002, the assets and liabilities of ABI Enterprise, a trading concern, were premises 26 million Ghana cedi, vehicle 15 million Ghana cedi, stock 6.6 million Ghana cedi, trade debtors 17.8 million, trade creditors 12 million Ghana cedi, and expenses owing 6.4 million Ghana cedi. At the end of the year, the assets and liabilities were premises 23.40 million Ghana cedi, vehicles 23 million Ghana cedi, stock 6.3 million Ghana cedi, trade debtors 12.60 million Ghana cedi, bank 7.1 million Ghana cedi, trade creditors 8.40 Ghana cedi, loan 10 million Ghana cedi. There were no additions to or drawings from owner's equity. Using the assets liabilities approach, what is the net profit?
Okay, thank you. All right, so before we even go to the question, let's go to the requirements. Using the asset liabilities approach, what is the net profit? First of all, we are not targeting the question, but how do we find the net profit from the asset and liabilities approach? So far, how do you see it? What is the approach? I just want to be sure we are all following. So, how do we find the net profit using the asset liabilities approach? Any volunteer? How do you find profit using the asset liability approach? Yeah, trade.
No, master.
The trade. Do you want to make a point?
No, sir. No, sir.
Okay, so who wants to help us? You've spoken on it just in a previous slide. I just want to be sure you are all following. That's what I'm asking. How do you find the profit using the assets liabilities approach? The method itself speaks for itself. So I don't expect you to delay too much on this. Okay. How do you find the net profit?
Hey, please. Assets plus equity. No.
The net profit is the
Liabilities
same as
plus equity.
so it's asset minus liability, which will give you
Okay.
the equity. That is why I highlighted in the previous slide that the equity is the same as the owner's the stake or the interest. Here we are looking at profit. So the capital will be the same as the net equity or the net stake of owners. Okay, if I'm to go to the previous slide so that you get it well. Yeah, the residual value is called capital or owner's equity or the net interest of the owners. So we are trying to ascertain profit using the asset liabilities approach. So if you are ascertaining profit using the asset liabilities approach, it means that the net interest is the same as the net profit or capital. I hope you get it. So here, if you look at the equation, assets minus liabilities equals capital. So your assets minus liability will also be equal to what? Your profit. I hope you get it. Please, are you there?
Yes, sir.
Yes, sir. Yeah.
So if you are using the asset liabilities approach, your profit will be the same as your capital. All right. So from this example, it means they gave us two at the beginning of 2002. It means you have 2 dates to deal with. At the beginning of 2002, the assets and liabilities of ABI Enterprise were premises, premises, vehicles, stocks. Stocks is the same as inventory, trade debtors, trade creditors, and expenses only. These are the information on the assets and liabilities. Now it's up to you. These are the opening balances. It's up to you to know which one is an asset and which one is a liability. So let's go through one by one. Premises, asset or liability? Premises,
Assets.
is it an asset or liability? Okay. Is it a short term or long term? Patricia, your hand is up.
It's a long term.
It's a long-term liability. Sorry, long-term assets.
I had long term liabilities. My mind just came on it. Okay, so you corrected yourself, right? Okay, that's good. Okay, so vehicle.
Assets.
Vehicle. Okay, that's good. Stocks or inventory. Please specify if it's long term, non current asset or current asset.
Current asset. It's current asset.
Patricia. Okay. Ike. Patricia, your hand was up.
It's a current asset.
Right, thank you. Trade debtors. Who is going? Isaac Kofi, your microphone is still on, so answer. You want to talk, that's why it's still on.
It's an asset, current asset.
Okay, trade debtors, current asset. Mabel, which one?
Sorry.
Okay, good. Trade creditors.
It's a liability, current liability.
What makes it? Okay, thank you. But what makes it a liability? For the sake of those who don't know, what makes it why is it a liability?
It's a liability
Who are
because
trade
the company is owing. He bought on credit, he didn't pay. So he has to settle that amount, he has to pay. So it's a liability.
Good. And it's a short-term liability or current liability.
Yes, current
All right.
liability.
Okay. Expenses owing. So if you are owing expenses, you know, it speaks for itself, right? You are owing expenses, it makes it a liability. How about expenses prepaid? If there was an expenses prepaid becomes an asset or a current asset. Sure, Isaac, thank you. It becomes a current asset because you have paid in advance of what is yet to be used or consumed. Okay. So that is what ECG they are doing now. Instead of initially used to be expenses owing, it used to be postpaid, but now they are going the prepaid way. You pay before you use. They don't want to come and chase you after using it. You don't want to pay. They will come and disconnect your light. When they go, you connect it again. Now they are also moving up. Instead of the postpaid, they are going prepaid. You pay before you use. Yeah, something like that. So all these are the opening balances. So if you want to ascertain the capital, when I explained earlier, I told you that you find the capital at the beginning, okay, at the beginning of the period, and you compare with the capital at the end of the period. The difference between the two capitals will give you either your profit or your loss. If it's an increment in capital, it becomes profit. But if there is a reduction in the capital, it becomes what? A loss. All right, so these are the opening balances. So we've been able to ascertain that premises, vehicle, stocks, trade debtors, these are our assets. And our liabilities are trade creditors and expenses. So the assets minus liabilities will give you your opening capital because the question said at the beginning of 2002. So that's the beginning. And if you look at the third statement, it said at the end of the year. It means from this side, whatever we are going to mention there are the closing information, closing assets and liabilities. So first of all, let's all ascertain our opening capital. Let's use our calculators. Opening capital. So premises, you add all the assets, you add all the liabilities, then you subtract the liability from the assets to get your capital. You know the equation already. Assets minus liability will give you your opening capital. So let's do the opening capital as at 2002. Let's all do it together. If you have a calculator with you, can you help us? So this becomes the assets, and this becomes the liability. So let's all do it together, please. When you are done, then you give us the figure. Then somebody can also confirm if the figure is okay. Please, I hope you are doing it. Let's hope you are doing it. Are you there? I want to be sure you can hear me.
Yes, sir.
Hello. Okay. All right, Erica. Okay, Patricia, thank you. So let's do it quick and give me the figure so that we can continue. What's the opening capital?
$65.4 million cedis.
65.4
65.
million Ghana cedis.
Okay.
So that's for assets.
So that is confirmed, right? Two people have confirmed it. All right. So now, at the end of the year, the assets, is there anyone who is having challenges ascertaining that figure? Because I had only two people speaking on it.
Say,
Is there anyone who is having challenges? Okay,
say,
Patricia.
please, the figure they mentioned is the total amount of assets.
That's the total asset.
The 64.4 million. Yes, the total amount of assets. They didn't deduct the liabilities from it.
Okay, then it's wrong.
And that is what
You
they
want
said
the
in
capital figure, which is assets minus liability. Okay, so you can deduct your liability. I've highlighted the liability to be.
So the equity or the capital is 44 million.
44 million. So that's the opening capital, right? Because you are dealing with the beginning of
Yes.
2002. So let's say 1st January 2002. Okay. All right. Is the figure confirmed? Have you also checked? That's why I told you, say at least two people should confirm so that we'll be sure of what we are doing. Now let's go to the other side. So at the end of the year, the assets and liabilities were, so these are closing figures, which will help us to determine our closing capital. The same approach you use to determine the opening capital. So our premises is 23 million, vehicles, stocks, trade debtors, bank is also an asset, current asset. So trade creditors and loan becomes the liability. Trade creditors and loan becomes the liabilities. Please, is there anything you don't understand so far? My fellow non-accounting students, are you following? Do you understand everything we are doing?
Yes, sir. We are
Hello,
following.
right. So do you understand so far? Hayford, are you okay so far?
Yes, sir. Yes, sir.
All right.
I want you to go forward to also now ask some small questions.
All right, sir. Okay. All right. So now let's ascertain the closing capital. The same way we ascertain the opening capital. If you have done it, then you can let us know your figure. Anyone to confirm on it? All right. So in the additional information, they said there were no additions to or drawings from owner's equity. There was no additions to or drawings from owner's equity. So if there was additional capital introduced, you could have added it to the opening capital before you less from the closing capital. So if there are no drawings, there's no hand raised. Okay. Patricia.
So the ending of the year, the profit was 54 million Ghana cedi.
Do you mean the closing capital?
Yes,
54 million.
closing. Yes, please.
Okay. So now we have 54 million at the close. And what is the opening capital to?
44 million.
Good. So from 44 to 54. So now you can ascertain your profit as closing capital minus what? Opening capital. So in the beginning of the year, you started with a capital of what? 44 million. But as at the end of the year, your capital has increased to what? 54. It means that you have made profit of what? 10 million. Please, I hope you understand. If now, can you ask your question? Now, are you getting where we are gearing towards? So we are using the asset and liabilities approach to ascertain our profits, whereby we compare the opening capital to the closing capital. And if there is any increase in the capital, it's attributed to profit. Whereby when there is a reduction in the capital, we term it as a loss. Any questions so far?
No, sir.
Do you understand? Truth. Is everything going well? All right. So let's go to the solution and check. So owner's equity as at 1st January 2002. So this is how we did it. Exactly. So 26 plus 15 plus 6.6 plus 17, all minus the liability, and we are getting 47 million. And the owner's equity as at December was Patricia, did you say it was 54 million or 57?
She said
Sir, please
44.
repeat.
Is it
The beginning. It says, is it the beginning or the end?
the end?
The end was
The
54.
end figure. Okay, so it's the same as what we have here. Okay. All right. So it means that our net profit or income will be the changes in the owner's equity. And the changes in the owner's equity will be the 54 million minus the 47, which is going to give us 7 million. So this is profit of 7 million. All right. So this is a profit. So let's assume the opening is 54 million, but the closing is 47. How do you term it? A loss, right?
Yeah.
It's going to be a loss. All right. Please, do you understand it up to this far? Using the asset liabilities approach to determine your net profit. Now let's go to the revenue and expenses approach. Okay, so with the revenue and expenses approach, in the year, all the revenues you made is recorded. All the expenses you made. This is what most of us will do, okay? All the revenues you made, all the expenses you made. You sum all the revenue, you sum all the expenses, and you deduct all the expenses from the revenue to get your profit or your loss. I hope it's clear. So the net income, if you're using the revenue and expenses approach, the net income or the net profit is the difference between the summation of the revenue and gain. Come again. Okay. In the revenue and expenses approach, the net income is the difference between the sum of the revenues and the gains on one hand, and also the sum of the expenses and also losses on the other hand. And I think in our previous meeting, we were able to clearly distinguish between. Yeah, my network is going. Can you see my screen?
Yes, sir.
Oh, it's gone again.
Yes, we can see it.
Hello.
Yes, sir.
Sir,
We
we
can
can.
see it.
My internet dropped and it came back automatically. Wow. Okay. All right. So like in our previous meeting, we clearly distinguished between the the revenues and gains, and also the expenses and also losses, where we made it clear that the revenue are they are the income that comes from the major operating activities of the firm, and the gains were the incidental income that arrive because of the activities the business engages in. We gave some examples similar to losses. Okay, so if you are using the revenue expenses approach, the summation of your revenues and gains less the summation of your expenses and losses will give you the profit or the loss. An illustration is given here. So at the end of the first operating period, KU Enterprise recorded the following data. Sales revenue was 46.5 million. Salaries and wages 7.2 million. Office and trade expenses is 4.52 million. Rent, rate and insurance 1.0. Miscellaneous expenses, cost of goods sold, bad debt, discount received, discount allowed. Requirement: using the revenue expenses approach, determine the income of KU Enterprise for the first year of operation. So to begin with, now you have to understand which one forms part of your income and which ones will be classified as expenses in this question. So now let's identify our revenue items. Which ones forms part of the revenue or income? Sales revenue, income or expenses?
Revenue.
It's income.
Revenue. Or revenue, sure. Even the name speak for itself. Salaries and wages.
Income.
Expenses.
Salaries.
Expenses.
Okay. Salaries and wages is an expense item.
Expenses.
All right. Office and trade expenses.
Expenses.
Okay. Miscellaneous expenses is expenses. Cost of goods sold.
Sales.
Yes,
Sales revenue.
Cost of goods sold.
It's revenue.
Sir, please, I have a question.
Are you sure?
Yes.
Okay, your question.
Please, why is salaries and wages and expenses?
Okay,
salary and
so
wages are expenses.
how do you understand salaries and wages? Yes, she's asking why is it an expense item. So I want to know how do you
Salaries and
understand
wages.
salaries and wages? Please, can you hear me?
Salaries and wages. Salaries and wages are remuneration to pay to the workers. So it is an expense. It's an expense because it's not money coming into the organization. It's money that is going out to pay your workers. So it's an expense.
Sales network has dropped.
Online classes. Problems here.
It looks like today the network was bad
Very bad.
because most of our meetings there were problems.
Yes, it has been like that
Yes,
whole week.
very bad here.
The network has not been good this whole week.
Exactly.
Hello, hello.
Yes, sir.
Oh, today the network is really bad. It's really, really bad. It's not really helping. Yeah, sorry. Can you hear me now? Are you back online? Yeah, so salaries and wage. Please, can you hear me? I want to be sure first.
Yes.
Yes.
And can you see my screen
No.
too?
Oh,
Can you see my screen?
No, please.
no, sir. Yeah.
It's now showing.
So, is it on now? All right, so,
Yes,
okay.
please.
So, salaries and wages. Maybe you have a staff, you pay them, okay? Good. So, the money you pay to them is an expense item. You are in business. It's not a revenue to you. You are not the one receiving the salary. You are the one paying the salary. Okay. Are you there?
Okay, sir. Yes, I'm here. Thank you.
Hello.
Hello,
All
I'm
right. You are
here.
the one paying the
Thank
salary,
you,
so it
sir.
becomes an expense item. Okay. So, okay. All right. You're welcome. Okay. How about discounts allowed and discounts received? Take them one by one. Discounts allowed. Is it an expense item or income? It's really bad. Discounts allowed.
Sir, please, your screen is not showing.
Discounts allowed.
Discount allowed as an expense. Sir, please, your screen is not showing.
It's an expense item. Yeah, I'm trying to connect. I think it's the internet. Network is down. Surely down. But can you hear me?
Yes, we can hear you.
Yes, sir.
All right, okay. I've used my phone to join too in case of emergency, then I can easily switch. All right. So the slide is going again. The discount allowed. Discount allowed. If you can hear me. Is it an expense item or is an income item? Discount allowed.
It's an expense.
Are you there?
Expenses.
Hello? Are you there?
Yes, we are there.
Please, can you hear me?
We are here. By some today, the network is very
Okay,
bad.
Beatrice. So discount. Okay, so
We
discount
can hear
allowed.
you.
Yes, it's really bad. I'm really surprised. I'm trying to share the slide with you. But I'm trying to share and network is just connecting and reconnecting and disconnecting like that. Okay, so discount allowed is an expense because the business is the one granting the discount to the customer. But on the other hand, when it comes to discounts received, it means that the business is the one receiving the discounts. Please, do you understand the difference now?
Yeah.
So if the business is the one receiving, then it becomes an income or a gain because it's an income. You know, the revenue have gains and income and gains, right? So the one that is not really from the major activities is what we classify them as the gains. But here, all of them becomes an income. So from this question, the income is going to be the discount received and also the sales revenue. So let me share the slide with you on the page whilst we try to reconnect. All right, so let's continue whilst the slide is loading to you. Let's continue. So you have to now group all your revenue. You find the summation of the revenue, then you go to your expenses too, and sum all the expenses as well. I'll share the slide on your WhatsApp page. So you can open it there, then you can follow from there. So we are currently on slide 7. I'm also trying to reconnect. Please, I hope you heard me. Hello, did you get me?
Yes, sir.
All right, okay.
Yes, sir.
Okay, thank you. So from there, the revenue items will be sales revenue, which is 46.5 million, and also discounts received. These are the two revenue items identified. Bad debts. What is bad debt? How do you explain bad debt? If you say a debt is bad, what does it mean? Bad debt. Anyone to help?
It means those customers owing the business and they are not able to pay for a period of time.
Good, good. So a debt become bad maybe after a kind of a period payment has not been effected, okay? We turn it as bad because of the duration and all that, okay? So this means the bad debt also becomes an expense item. Okay, so salaries and wages, office trading expenses. All these are expense items. So now I think now we can group the expenses and the revenue. So we have only two revenue items, as I said, sales revenue and also discounts received. All the others are expenses. So let's use the revenue expenses approach to also determine the net profit. I didn't want to give you the slide because we have the solution in there. I want you to follow first. But because of the internet connection, that's why I'll share the slide with you. So please don't overuse it, okay? Don't convince me that you understand the thing while you are reading the solutions to me. Okay, I want to know that indeed you understand what we are doing. So who can help us with the The profit or loss. And is there a profit or a loss? Is there a profit or a loss? Please, I hope you can hear me.
Yes, sir.
All right. So are you making a profit or loss? Let me know, please. Profit or loss? Let's get the computation. Profit or loss? Are we doing it? All right. So this is how it's going to look at. So the solution, the net income will be the revenue plus the gains minus the expenses and also the losses. The revenues, as I said, we have 46.5 and also the 0.250. And the expenses are also outlined below. So in all, we are going to get total revenue of 46.750 and a total expenses of 42.5. So at the end, we are going to get profit of 4.220. Okay. It can also be a loss if the expenses are more than your income. You are going to incur a loss. All right. Now we are moving on to the accounting concept. Please, I hope you can hear me. Because of the internet connection, at every point in time, I have to be sure you are being followed. All right. Thank you for the heads up. So we are moving on to accounting concepts and principles. As an accountant, we are being guided by accepted rules, okay? Rules and regulation that will help them to be as objective as possible so that people will not make business decisions based on their own intuition. Any business decision you make or any decision you make as an accountant should be guided by accounting concept and also the principle that is governing the profession. Right. So certain assumption, principles or conventions must be understood and applied. So that when somebody is saying that, hey, anybody that have not paid, that does not buy with cash, you don't record it as cash received. Yeah, you are not recording liabilities. You only record when the monies are received. All these are guided by principles and also on concepts in accounting. So now let's look at some of these concepts. So we have some basic ideas. Some basic ideas are assumed to exist so that accounting activities can also be meaningful. If these ideas are not accepted, then accounting will have no foundation. As I said, it should be guided by principles. Anything you say should be guided by principle. Every financial information you present should be guided by principles. So these are some of these assumptions we are going to talk about. We have one, business entity concept is one, going concern concept, money measurement concept, and also periodicity. Okay, these are some of the assumptions. The main assumptions in accounting is the business entity concept, going concern, money measurement, and periodicity. These are the main assumptions. So maybe in an examination or anywhere, you can be questioned to explain the main assumptions that is being used in accounting. You should be able to explain business entity, going concern, money measurement, and also periodicity. Business entity. If you say business entity, what does it mean? So business entity separate and distinct the business from its owners. Hold on for me, I'm coming. All right, sorry, had a call, so I had to break. So business entity. So this assumption states that the business is an entity which is separate and distinct from its owners. Please, I hope you are there. The business entity concept states that the business is an entity which must be separate and also distinct from its owners. Okay, this concept is separate from what we mean as legal entity. When you talk about legal entity, it means that sole proprietors and partners of a firm and their entity are one. Okay, because sole proprietorship, the business is not really separate from the owners. Okay, but because the owner is actually the business, because it's one man business in a way. That is how we see it. The business entity concept means that the business must be separate from its owners. The business must be able to account for the activities or the monies that has been used in the business. Okay, so the business entity must be separate and distinct, separate from the business, from the owner, sorry. So the importance of this assumption is that it enables the owner or other interested parties to know the profit and also the capital employed in the business. Because if the business is being separate from the owner, you see, in our forefathers or in our mother's era, when they are doing business, they don't really check the amount they invest in the business. So once they have money there, they just put in the business and start selling. They don't really do any calculation. Okay, I've invested this in the business, so I'm expecting to get this. Or at the end of the period, you account for this. They just buy the things and sell. And if they are there, they need some money, they just take it out of the business. They just use it. They don't account for it to know if the money is being used properly. The business is running down because there has been excess withdrawal in the business. Okay. So even as a business owner, if you want to be disciplined, even if you take one CD from the business, you have to repay. You have to see it as a loan you are taking from the business. Don't assume it's yours, so you just make withdrawals anyhow. Okay, so try as much as possible to separate the business from the owner. Don't join them. Take money, anyhow. So that is the main tenet of the business entity. There is a drawback to this. The drawback is that this separate existence is artificial. But the business entity is like an empty shell, since the resources that is being held are being owned by the owners. Please, do you understand it? They see this concept to be a drawback because the resources in this business is being owned or invested by the owners. So why should it be separate from the owner? This is a drawback to this concept. But the importance is that it helps in accountability. Okay, it enables the owner or any other party to know the profit that has been earned by the business because there is data availability about the business. You don't just make things anyhow because it's for you. You just take money out without recording and anything. All right. Please, as I move on, if you have any concern or issue that needs to be addressed, then you prompt me. Okay. Going concern concept. So the going concern concept states that enterprise or the business will continue in operational existence. It will continue to operate into the foreseeable future. So there's no intention of liquidating the business. There's no intention of collapsing the business. The business has an intent to operate into the foreseeable future. They want to go to the future. That is the going concern. So when a business has a going concern assumption, it means that they intend to operate into the foreseeable future. They don't have any intention to liquidate the business or any intention to close the business. So if a business is applying a going concern concept, it means that they have to account for every activity that occurs. Okay. So the balance sheet and the profit and loss account are drawn up. They are drawn every year with the assumption that there is no intention or necessity to liquidate the business. And as such, it is crucial to make an account at the end of every year to know the state, the financial performance, and also the financial position of the firm. Okay, and what is the drawback? The drawback is that the assumption can be misleading. In other words, it is not easy to tell from the final account whether the entity will fold up or really continue as a going concern. And this is very true. It is not easy to tell. You know, some business, now we are in Ghana, okay? We've experienced a lot of collapse in the financial sector, a lot of businesses collapsing in the financial sector. But these businesses, you see, every year they prepare accounts and it's being audited by auditors. Some of you may have been working with some institutions and maybe you've been hearing about these things. Okay. You will see a juicy financial statement out there which will attract people to even come and invest in the firm. But within some short possible time, the business has collapsed. And you ask yourself, how? So all these figures that were stated, was it just a lie? Or just to window dress things so that people will see that the business is doing well? But meanwhile, in the background, all these are just fabricated figures. So they are saying that the going concern concept can be misleading because you cannot tell from the final account whether the business will operate into the foreseeable future. Please, any question? Do you understand the concept? Do you understand it? All right, Beatrice, thank you. Okay, we also have money measurement. Okay, it means that accounting transactions should be recorded in money terms. Financial statements are drawn up with the element, okay, and they must all be expressed in money terms. Every financial information, every financial transaction should be recorded in terms of money. Okay. And the importance of this assumption is that without it, it will be impossible to summarize the events of the financial year. It will be impossible to know the financial position of the firm. It will be impossible to know the financial performance of the firm because there has to be a unit of measurement. And here the assumption is that all accounting transactions should be recorded in terms of money. Okay, so that we know that, okay, we are saying the business is performing, not because maybe people are coming to the business every day. Maybe some of them, they are just coming to visit their friends. Maybe in a way, let's say you run a school, okay, people coming there does not mean they are coming to school. Maybe they are coming to make an inquiry. How do you assess the performance? It has to be a unit of measurement. And this concept or assumption is saying that all business transactions should be recorded in terms of money. And it makes it possible to summarize the events of the year, activities that occurs in terms of money, to know how well the business is doing. What will be the drawback? It means that any event that cannot be expressed in terms of money will be ignored. Maybe there are some things that cannot be expressed in terms of money, and those things may be ignored. And they're also saying that money as a unit of measurement is unstable, and the price levels change with inflation. So since there is no stability in the unit of measurement, it becomes a drawback. And another drawback is that the event that cannot be expressed in terms of money may have to be ignored. Okay, so we made the decision only based on financial or monies. That is how we assess the performance of the business. What do you think will be some of the non-financial information that may be ignored if this assumption is applied? What do you think will be some of the non-financial information that can occur in a business? Okay, anything that you think it cannot be quantified in money term, but it might be a good point when it comes to business, that can be ignored. Anything? Anyone to help? Mabel, you want to?
Please, yes,
Hello?
management performance.
Management performance, that's very good. Management performance can be one. That's true. Any other? Any other who can help? Management performance is one. Any other? Hello, are you there? Please, what do you think would be other non-financial information that can help? That cannot be quantified in monetary terms, but maybe one or the other. They are also important in reaching the goals of the firm. Management performance is one. Employee performance too can be. Because on the face, it's not everything that will be recorded. Maybe sales figure can be recorded, but the effort that the employees put in to arrive at those figures cannot be recorded on the face of the financial position. Okay, it will be ignored because there has to be a unit of measurement. Okay, maybe the management performance, we can even say that maybe the manager's wife has been cooking good food for the husband. That is why he's always motivated to work harder. There are a lot of things that happen at the background before certain figures are written. Do you understand that? Portia agrees with me. Okay, there are lots that happens, but it cannot be quantified in words. Money terms. There are people behind the scene doing so excellent for businesses to stand, but because their effort cannot be quantified in money terms, they are being ignored. Maybe a pastor is praying for the business to grow, and the business is growing. But do you think the prayer can we put there that prayer point to see this per point? So at the end of the year, the prayers were 1,000 cedis. It cannot be quantified. Okay, so such things will be ignored. These are the things we are talking about here. All right. Periodicity, from the word period. A business is assumed to have a long life. From the previous concept, the going concept shows us that the business is supposed to have a long life. They are supposed to operate into the foreseeable future. It is further assumed that this long life should be divided into shorter periods, okay? Because if a business is going concern, it means that the business has the intention to operate infinity. There's no ending time, forever. Okay? But you cannot say because of that you are not going to do any harm until forever. So there has to be a short, the long life has to be divided into shorter period. Okay, so that at every point in time, there can be accountability at regular interval. Maybe at the end of every 31st December, we are going to read a budget, something like that. Or we are going to draw Ghana budget, something like that. So at the end of every business cycle, there's going to be accountability. Maybe at the end of December or at the end of every quarter, we are going to prepare our account. Okay, so that balance sheet, we can know the financial position, also the financial performance of the firm as at that point in time. Okay, you cannot wait till the end of the business life before profits are ascertained or performance is assessed. Okay, and for tax purposes, every year the account has to be established so that based on your performance, you can be assessed for tax purposes. These are the drawbacks. Not all business transactions can be identified with a particular period. In practice, many transactions have consequences for many periods. Okay. Some expenses cannot be classified under a specific accounting period. Maybe that expenses is supposed to last forever in the business. Okay, these are some of the drawbacks. And periodic income determination also becomes problematic, and a range of principles has to be developed to properly relate transactions to specific period. Because as I said, there will be some expenses that are supposed to span beyond one financial year. How do you spread these expenses? How do you spread them over the years? All right. historical cost. Historical, from the word history, historical cost. So this concept states that the assets and liabilities are supposed to be recorded or entered in the books at their original cost to the business or at the actual cost. Okay, they are supposed to be recorded in the books of the firm at the original cost, how much we acquired them from the beginning of the business. Even if those values have increased as at now, there shouldn't be any revaluation. Those business figures, the asset figures are supposed to be recorded. The asset that we bought in 1998, if you bought it at 2 cedis, the business has been in existence up to now. It has to be recorded at the same 2 cedis. This is the historical cost concept. So the importance of this is that it provides objectivity needed in recording accounting transactions. And also, if assets are acquired or obligations are incurred, they were to be measured at their current or realizable value. Subjectivity will set in. Okay, because in Ghana here, the same item, when you go to one shop, the price will be different from the other shop. So the historical concept will be like, no, let's maintain it at the original value. Okay, if you are to increase, which value are we going to use? Are we going to use the one at store A or store B? How do we do the revaluation? So the asset items are supposed to be recorded in the books at their original cost. Okay, revenue recognition. When you talk about revenue recognition or realization, it means that when a transaction, example is sales, when sales has occurred and the legal right to receive the money therefore is given, it means that the revenue has been realized or recognized. Okay, you sell items to somebody, the person pays. So until the money is received, revenue is not realized. Okay, it becomes unrealized. So until the monies are received, the revenue is not realized. So the principle in general holds that revenue is recognized or realized when goods are sold or a service is rendered and the client incurs a liability for the sale or service enjoyed. So you perform a transaction, you perform a service for somebody until the person make the commitment, until the person pays you, until the person makes that financial commitment, revenue cannot be realized for that purpose. Okay, revenue cannot be realized for that purpose. So let's assume you are a firm that are into rentals. Okay. You rent into apartment estates and all that. So you have a bedroom you've given out for rent for 3 years, 3 years advance. You've taken 3 years advance. As a business person, you cannot realize or recognize all the 3 years figure in the first year in which you receive the money. You cannot record all the figures in the first year in which you have received the money. So it means that you have to spread the money. Even though you have received all the figures this year, but not all those revenue are supposed to be recognized this year because it's a 3-year rent figure you've taken. So you only have to divide by 3 and realize or recognize only this year's own. And the next 2 years own will be unrealized profit in your books. Until it gets to the 3rd year, you cannot realize the 3rd year figure. You record in your books as unrealized profit, even though you have received it, but the service has not been performed for that purpose. Please, I hope you are here with me.
Yes, sir.
All right, thank you. Accrual concept. Accrual concept. So this concept also holds that revenues and costs are recognized and they are included in the profit and loss as they are accrued. That is, as they are earned or incurred, and not as they are received or paid. Okay. So this concept is also saying that revenue and expenses are supposed to be recorded immediately when they are incurred, whether cash is paid or received for that. It doesn't matter. That is what they're also saying. Once the expenses or the revenue is incurred. Once they are incurred, they have to be recorded. Once they are accrued, not when cash is paid or received. So the accrual concept, they treat revenue as earned during a given period, whether cash is received or not in that period. Okay. Some of us, we are living our lives on the accrual concept basis. The moment even somebody promise you money, the money is already in your pocket, even though the money has not been given to you. And you start spending money that you have not even received. This one, we are all victims of that, unless somebody is here who will feel otherwise, who has not ever tried to spend money that has not been received before. Maybe it's only Patricia. Oh, Patri, you've already spent February salary, right? Even though you've not received it. Mhm. Yeah, so this is what we are talking about.
I've not
Most of
even
us, we are
received
living,
January yet, but it's gone.
it is gone. Yes, you understand.
I've
Good.
not
So
received
most of us,
January yet, but
this is gone. Some have even spent up to March. They have already spent up to March salary already, even though they can see the future. They've spent in advance. Good. So people are living their lives on accrual concept. Okay. That they are saying that revenue is earned during a given period of time, whether cash is received or not. And also expenses are incurred, whether cash is paid or not in that period. Expenses is incurred. Matching concept or matching principle. So the matching principle is saying that in accounting period, when revenues are recognized, the expenses incurred in earning those revenue is supposed to also match with it. Okay. Revenue is recognized, hidden expenses incurred in realizing or recognizing those revenue has to be matched with it. Okay. And it has a major drawback. The drawback is that it's difficult to determine the expenses which should be associated with a particular revenue, because some expenses can cut across all revenues. Example is rent and rate. Okay. You are a manufacturing firm. The building you rented, all the activity takes place in the business, right? So if you have different segments and you are making revenue from different segments, how do you allocate the rent to only one unit? Because the building is serving everybody in that room. So sometimes it becomes difficult to sentence or apportion the expenses in the rent to the revenues. Okay. Maybe going forward, you understand more when you get to manufacturing accounts, whereby we do a proportional, maybe pro rata basis in sharing expenses. Okay. Objectivity. To be objective, it means you must be free from bias. When information is presented, it must be free from bias. And it is not slanted to a specific user. It must be objective. So when there is available adequate evidence attesting to the validity of the data used in a financial statement, it must exist. Okay. Information must be objective. It must be free from bias. It must be free from any bias. And consistency. Consistency means that once a method has been chosen, that method should be applied consistently. When a method has been chosen, that method has to be applied consistently. We also have materiality. So materiality means that some businesses, what will be material to one will not be material to the other. Okay. So the materiality concept states that amount of small significance need to be accorded straight theoretical treatment. Okay. The principle is important in the sense that the accounting information provided will not be loaded with insignificant figures. So in some firms, it's not everything they record on the face of the financial statement. It's not everything that is being recorded on the face of the financial statement, because what will be material to one may not be material to the other. Okay. So some items, they treat them as insignificant. And I think in our first meeting, I made a perfect example. I compared the automobile firms to maybe University of Cape Coast. Maybe in the automobile firms, they deal in cars. They deal in maybe they buy pens in the office to write, but pen and cars, the figures is huge. They will not treat pen as a significant item. There may be a stationary firm. Pen will be an asset too because those are the part of the things the person deals in. Okay, so what will be material to one may not be material to the other. That's why we have miscellaneous items or miscellaneous expenses in some firms. Those ones, sometimes they use the petty cash system to cater for those miscellaneous. So a petty cashier will be in charge of an impress. Okay, so that some miscellaneous expenses will pass through the impress so that it doesn't pass through the main financial statements. At the end of the period, you retire the impress. If there's any reimbursement that has to be done, it has to be done. That is how the materiality is. And prudence, conservatism, prudence. So the prudent principle also state that where there are alternatives exist, the accountant should select the most least favorable immediate effect. As an accountant, you should be able to anticipate losses, but you should not anticipate gains. Okay, you have to anticipate losses, not gains. The importance of it lies in the fact that accountants are very cautious people. If anticipated losses do not materialize, nothing is lost. You anticipate loss in a period, but the loss does not occur.
What does it
You
mean?
anticipate losses. Hello, somebody's mic is on.
Yes, sir. I said to anticipate loss. No, what does it mean?
Okay, it means that you are assuming a loss can occur in a business transaction. Anticipation means that it's more of a forecasting.
Okay.
So it's better to anticipate loss in a business than to anticipate a gain. Because if anticipated losses do not materialize or occur, nothing is lost. But imagine if you anticipate a gain and it doesn't happen. It's more of a catastrophic decision, right? You anticipate that this period you are going to make first class, you are going to get first class. And maybe at the end of the period, even third class, you struggle before you had. Then maybe sometimes it's good to lower your expectations so that when it happens above that, it becomes a joy. Okay, I cannot compare academic to business. For academic, we all hope to get the highest grade. Okay, and sometimes we work towards it. But when it comes to the business food, it's not like that. You don't have to anticipate gains. Because if the gains do not occur, it means there is a loss. But if you anticipate losses and losses do not occur, nothing happens. Okay. So I think this is where we are going to end today. We've learned about the business concept and the business assumption that guides accountants in making some business decisions. Any questions so far? So we spoke on prudence, we spoke on materiality, consistency, objectivity, the matching principle, the accrual concept. Some of these concepts you might need them in maybe multiple choice question. They'll give it to you and they'll ask you which concept is this. You should be able to. So make sure you go through and you understand every concept that has been laid down on the screen. Historical concepts, periodicity concepts, and also money measurements, the going concern, and also the business entity. Is there any of the concepts you did not understand you want me to clarify? If there are no other suggestions, then we will end here for today. Any suggestion, any question?
Sir, how do we get the slide, access to the slide, so that we can go through?
Mike, are you on the platform?
Today is the first and last week I couldn't join.
Okay. So the rep will share the link here. Erica, are you there? Okay, Erica, I think we appointed another person to work with them.
Yeah.
So, Truth, okay. Truth, you can share the link here so that those who couldn't join the other time, they
Okay,
can
sir.
be able to join the WhatsApp. I've already shared a slide. After every meeting, I shared a slide on the WhatsApp platform. But today I shared it in advance because of the way the network was messing up. So that even if I'm unable to share my screen, you can also follow from your side.
So,
Okay. Okay. I think something has been shared in the chat box. So check the chat box. No, that one is spell. Okay. All right. Or you can also drop your number in the chat section so that I send it. Someone can send it on the WhatsApp page for it to be added. All right. So if there are no further, I would like to end the meeting here. Then we hope to continue maybe tomorrow, or you talk about that when you meet tomorrow. Okay. Have a nice evening. I hope you enjoyed today's meeting too.
Yes, sir. Thank you very much, sir.
You're welcome.
Yes, sir. Nice evening.
Okay. Thank you, Portia. Same to you.
Hey, I see meeting around.
yes, Newton.
Okay, I'll add you to the group one.
Yes, please. Thank you very much.
Okay, which region are you from?
Come again, please.
Which
I'm
region?
from Volta,
Who?
but I stay in Accra. I work at Shah Sudoku Hospital.
Oh, okay. We are next. So.
The accountant.
Oh, okay. Yeah,
Thank you very much, sir.
you're welcome.